More and more family offices are looking for alternatives to stocks when it comes to putting money to work. And Robert Frank joins us now with more. Hey, Robert.
Good morning, Joe. Good to see you. Well, family offices have become the fastest growing market for alternatives and private assets. The number of family offices with exposure to alternative investments has increased by over 500% since 2016. That, according to new data from Preqin. Now, the growth outpaced wealth management firms, sovereign wealth funds, and even endowments. There are now over 4,000 family offices with alts investments. That's up from just 650 back in 2016. Now, within the alt space, so that's private equity, private credit, venture capital, hedge funds, real estate, infrastructure, all those things, family offices are favoring private credit this year. According to BlackRock, 39% of family offices plan to add or make new investments in private credit and private debt this year, with 29% planning to add or make investments in private equity. Private credit, though, is still a fairly small share of total family office portfolios, about 5%, and family offices are warning of higher fees and lower returns. With hundreds of billions of dollars pouring into private credit funds, family offices say returns have started to fall a bit, and 72% of family offices say high fees are the biggest challenge to investing in private markets. Now, for more on the family office boom in alts, you can read the latest story by my colleague Haley Cuccinello in the Inside Wealth newsletter on CNBC.com/InsideWealth. That's CNBC.com/InsideWealth. The new newsletter out tomorrow morning.
People love alternatives. Every week we have another story about the expansion of things other than conventional investments. What's the problem? The stock market's great.
The argument is that when the entire American retirement system is pegged to NVIDIA stock, that could be risky. And so with 80% of American companies that have over $100 million in annual revenue, 80% of them are private now. You want broader exposure, and to get that, you need to go through private markets. That's the argument.
That's the argument, but really the rationale is I'm rich, I'm special, I should have access to something better than the average American can get access to through the S&P 500, right?
Well, more and more they want those products to be available to everybody. But the argument was not to be special because you're rich, but because you're getting paid for that illiquidity premium, keeping that capital in longer rather than a liquid investment, which is more volatile and gets you lower returns. That's the notion. We'll have to see what happens with returns now that so much money is pouring into private credit, and private equity hasn't had exits.
It's going to compress. It's got to compress.
It's going to compress. Yeah, you're going to have to see fees come down.
I know. I was glad to see the Lowe's deal. Someone was able to sell something, from private equity.
Well, by the way, talking about private equity, it's fascinating to go look at like KKR stock, Apollo stock, some of these private equity stocks, with the exception of Carlyle. They've actually underperformed.
They're down this year. Many of them are down this year.
There's all of this talk about moving, the American public into 401ks that have access to these funds. It's very interesting that in the run-up to that, they moved. They definitely moved.
And they're still up from the election because they had a huge run-up. But they're sitting on 30,000 portfolio companies now worth around $3 trillion that many question, are they going to be able to exit at the same prices or better that they entered in?
Right. So my fear is not...
And if you have more people who are investing in those things, that's a good way to get get it, right?
That's the only way to get it.
This is what I worry about, because there's going to be a hot potato game that's going to happen right now. It might work long term, but in the short term, what I worry about is once all of these investors jump in, they'll unload some of this stuff, and it won't be, at least early on, it's going to be tough.
Yeah, we'll see.